Hello everyone, I am Dr. Kotha Anil Kumar, Assistant Professor, Department of Mathematics and Management Science, JYOTHI, Institute of Engineering and Technology. Today we are going to learn about Introduction to the Accountancy as a part of Engineering Economics and Accountancy. Introduction. Generally, the main purpose of business is to earn the profit. So, to know the profit or loss of the business, you need to record all the business transactions in a systematic way. So, there are so many systems are there. So, basically, initially, Luca Paciolo introduced a double entry system to the world. Next one is before going to the accountancy. So, let us observe some terminologies which are frequently used in the accountancy. First one is business. Business is an activity which involves exchange of goods and services conducted with the intention of earning profit. The main basic requirements to become a business that must include of exchange of goods and services. Next one is intention is to earn the profit. Second one is a business transaction. It is an activity of the day that includes purchase or sale of goods and services or payment or receipt of cash. Next one is a cash transaction. If the payment is made immediately after the transaction, that is called as a cash transaction. Next one is a credit transaction. If the payment is postponed to the future date, such a transactions are called as credit transactions. Non-cash transactions generally not involves any cash payments. Generally, that passes one entry in respect to the another entry. Proprietor, it is the owner of the business who introduces the capital, who commences the business. Capital, it is an amount introduced by the proprietor at the time of commencement of the business. Drawings. So, whatever the amount or goods taken by the proprietor for his personal use from the business. So, they are called as drawings. Goods. So, things which are purchased for the purpose of sales, they are called as goods. Generally, these goods are differ from one business to another business. Let us take one electronic showroom. So, all electronic goods becomes electronics items becomes goods to the business. So, next one is take an example of one steel vessel shop. All steel items becomes goods to the business. Suppose if the electronic showroom owner purchased a furniture, that become an asset. Electronic showroom owner purchased a TV, that become a good. So coming to the furniture shop, if the furniture shop owner purchased furniture, they are for the purpose of sales, they become goods. Suppose if he purchased TV, that become an asset. So goods means things which are purchased for the purpose of sale, they are called as goods. Next one is debtor, any amount receivable from outside. Generally, it is not possible to conduct all business transactions in cash or not advised to conduct in on debt or credit. So, generally, whatever the goods sold on credit, we need to receive after certain period. So, that all persons becomes debtors. Next one is the creditors, any amount payable to the outsiders. Whenever you purchase any goods from anybody on credit, they become a creditor. They arrange the goods on credit, so they become creditors. Next one is assets. Generally, they are also called as properties or things which gives long-term benefit. Whose benefit extended more than 1 year or within a year, so which are used for generating revenue, they are called as assets. Liabilities. So the term liability refers to the debts or amounts due from a business to others, either from money borrowed or for goods or assets purchased on credit. Next one is equity. Equity is an amount as a capital. Equity capital may be the amount introduced by the proprietor at the time of commencement of the business. Next one is book debts which are receivable from outside. They become a debts. Good debts which are 100% recoverable, which are most portion of the debts which are recoverable, they become good debts. Bad debts, debts which are irrecoverable, they become a bad debts. revenue, that is the income generated through operations, purchase and sale of goods and services. Expense, that amount paid for acquiring something. Loss, excess of expenditure over income that become a loss. Debit and credit, generally used while recording the business transaction in an account. Entry, that is a recording of transaction. Posting, whenever you post the transactions into the ledger, that becomes a posting. Next one is the book of accounts. So what purpose we are preparing, generally what type of accounts we are preparing, what type of books we are preparing to know the financial portion, that becomes a book of accounts. Journal, that is a recording of journal entries. Ledger, it's a group of accounts where we maintain personal, real, nominal accounts. So before entering into the accountancy, you need to learn these 4 items: capital expenditure, capital income, revenue expenditure, and revenue income. So first one is capital expenditure. Any expenditure which increases our earning capacity, that become a capital expenditure. So once again I'm repeating, any expenditure which increases our earning capacity, that become a capital expenditure. Or so any expenditure which is involves in the purchase of assets which are used for generating revenue, they become a capital expenditure. So coming to the capital expenditure, you see one example. So taken a cinema theater. So cinema theater, suppose if it is running with 1000 seating capacity, if they are selling per seat 10 rupees, the total revenue per show becomes 10,000 rupees. Suppose if the owner installed 500 more seats, the total sitting capacity becomes 1500. The total income increased to 15,000. Whatever the amount spent for increasing the number of seats from 1000 to 1500, that is called as a capital expenditure. So any expenditure which increases our earning capacity, that become a capital expenditure. So next one is capital income. Any income received by disposing of an asset, by sale of an asset. So that becomes a capital income. So sale of buildings, sale of machinery, sale of furniture. So that happens only one time in the lifetime. So that becomes a capital income. So next one is revenue expenditure. Any expenditure which is required for smooth running of the organization. So that is called as revenue expenditure. So best example, payment of salaries, payment of taxes, payment of electricity bills. So whenever you pay periodically, so generally there is a chance to run our organization without interruption. So any expenditure which is required for smooth running of the organization, they become revenue expenditure. So next one is revenue income. Income generated from day-to-day operations. Income generated from day-to-day operations, they become revenue income. In the last example we observed, so cinema theater. So the cinema theater income increased from 10,000 to 15,000. So the 10,000 and 15,000 become a revenue income. Income generated through day-to-day operations. So these are all 4 very important things in the accountancy. Capital expenditure, which increases our earning capacity. Capital income, income received by disposing of an asset. Revenue expenditure, expenditure which are required for smooth running of the organization. So revenue income, income generated through from day-to-day operations. So next one is coming to the objectives of the accountancy. There are limited objectives. First one is to keep the permanent, accurate and complete record of business transaction. So whenever record all business transaction, that easy to know the financial portion or to prepare financial statements. Or whenever you want to receive any amount from outside, so by looking into the accounts, recorded things, we can easily identify how much amount receivable or payable to from that person or to that person. Next one is to maintain record of incomes and expenses and losses in such a way that our net profits, losses for a specified period may be ascertained. So how much income earned, how much expenses we incurred, that are known with the assistance of recording of business accountancy. Next one is to keep the record of assets and liabilities in a such a way that the financial position of the business at any point can easily ascertain. So to know the assets and liabilities on a particular day, so recording of business transactions are required. So that fulfills with the assistance of accountancy. Next one is to enable the businessman to review the revise his policies in the light of past experiences brought to the light by analyzing and report. Suppose whenever you want to analyze or change the policies based on the experiences, based on the available records, we can easily change the system. Next one is to provide information for legal and tax purpose. So how much amount you are going to pay as a tax, that can be known with the preparation of final accounts. So that fulfills the accountancy. So next one is generally accepted accounting principle. Generally, these are the common policies, principles need to follow in a particular area or the India. Next one is basically the principles of accountancy are classified into accounting concepts and accounting conventions. Accounting concepts are classified into business entity concept, dual aspect concept, going concern concept, accounting period concept, money measurement concept, cost concept, revenue recognition concept, matching concept, accrual concept, objectivity concept. Next one is coming to the conventions. Convention of disclosure, convention of materiality, convention of consistency, convention of conservatism. Let us observe one by one. So accounting concepts. According to business entity concept, every business is different from its owner or the proprietor. Proprietor is treated as a capital arranged by that person, loan arranged by the person to the business. So business is differ from owner. So they have two different entities. Owner is treated as separate and business is treated as separate. So whatever the amount arranged by the owner is treated as loan arranged by the owner to the business. So that comes under business entity concept. According to this concept, every business unit is recognized as a separate from his owner, have separate entity. Next one is a dual aspect concept. So under two systems, there are single entity system and double entity system. Under double entity system, every business transaction is recorded twice. One is on the debit side, second one is on the credit side into the accounts. Generally, while writing the business transactions in the debit side, always consider receiving aspect as debit, and on the credit side, consider giving aspect. So whenever you record the business transactions, two sides, one is on the debit side, second one is on the credit side, automatically the accounting equation develops. So assets equal to capital plus liabilities. So take an example. Suppose if you took a loan 1 lakh rupees from a person or from the bank, the loan is a liability. But whenever you are receiving loan in the form of cash, that is a benefit, that comes under asset. So like that, the whatever the assets, they are equal to the capital and liabilities. Whatever the amount introduced as a capital and whatever the amount you borrow from the outsider as a liability, that must be equal to the total assets. So this comes under dual aspect concept. Under dual aspect concept, every business transaction is recorded twice. One is on the debit side, second one is on the credit side. So receiving aspect always debit side, giving aspect always on the credit side. That comes under benefit or the giving. Receiving of benefit, at the same time giving of a benefit. Next one is coming to the last one, assets. Cash may be the example, cash or buildings equal to the capital. Suppose that the total assets 1 lakh rupees. Next one is the cash and buildings 10 lakhs rupees. That must be equal to the capital. Next one is a going concern concept. The concept assumes that business will continue indefinitely and will not be liquefied. So for that purpose, you need to follow a separate procedure to record the business transactions. Next one is coming to the accounting period concept. So generally, you need to assess your performance, financial performance in a particular period. Maybe the period of 12 months, 1 year. So to submit our financial statement to the concerned department, you need to prepare a financial statement for the period of 1 year. Generally, you may follow either accounting, maybe the calendar year or maybe the financial year. Next one is accounting period concept. Generally, whenever you are preparing any financial statement, you consider expenses or incomes belonging to that financial year only. That concern, suppose if you are preparing 2025 financial statement, you consider expenses or incomes, assets and liabilities belonging to this 2025 financial year. That expenses or income which are not related to 2025 are not recorded under this accounting period, under this financial statement. Next one is money measurement concept. According to money measurement concept, so generally while recording the business transactions, you consider the transactions which involves in the cash, money. Whatever the services you rendered, that to be converted into cash. So only cash, such items are entered in the books. So non-money, non-cash transactions are not entered in the books. That comes under money measurement concept. Next one is cost concept, or also called as historic concept. According to cost concept, so whatever the amount you paid for acquiring a particular asset, that are allowed to record in the books. So basic purchase of asset. So suppose if you spend 1 lakh rupees, so you record only 1 lakh rupees inclusive of installation expenses. Suppose if you paid any installation expenses, add to the purchase price. So don't add any other expenses. That comes under cost concept. Whatever the amount you spend for procurement, so that is only allowed to record in the book. That comes under cost concept. So revenue recognition concept, generally it amount realized from sale of goods. Rendering services and holding of assets is called as revenue, and excluded amount collected on behalf of the third parties like taxes. Next one is a matching concept. We need to enter the expenses applicable to the current accounting year against the revenue earned to determine the net income of the year. Next one is a accrual concept. So there are two systems followed in writing the accounts, accrual and cash. Cash book is preparing basing on the cash system. Cash receipts and cash payments made are entered irrespective of the year which the transaction was. Matching is not followed and operating results are not in the conformity with the gap. So next one is objectivity concept. According to this concept, all transactions recorded should be supported by the verifiable document for future verification and auditing. So these are all accounting concepts. Next one is accounting conventions. First one is convention of disclosure. So according to disclosure, you need to disclose all information about the organization. Generally, the investors scattered at different places. Whenever they want to invest in the business, they verify their financial statement. Suppose if you want to try to hide any information that affects your company financial position or company investors. So because of that reason, for releasing any financial statement, you need to disclose your actual financial position. Don't try anything in front of the stakeholder or the investors. Next one is convention of materiality. All the facts which are necessary for the investor to make proper evaluation and take it decision are to be disclosed, like increasing capacity of the enterprise, change in the method of depreciation, or any event which would like to impact the liability should be disclosed. Next one is a convention of consistency. It is essential that the accounting practices remains unchanged from one accounting period to another period. Maybe the drawing of conclusion. Whenever you want to draw conclusions, so the procedures must be same. Whenever you are changing your procedures frequently, it is very difficult to draw conclusions between these two financial years. Next one is a convention of conservatism. So convention of conservatism, it is a generally a convention of all possible losses are to be considered, but all prospective profits are to be left. So business generally involves profits or losses. Generally, people are ready to enjoy the profits, but whenever they are in the losses, they are not interested to bear the losses. So you are ready to accept these two things. So because of that reason, it is a one type of game. You try to accept profit, you try to accept losses. So best example for this, provision for doubtful debts and a discount for debtors. So valuing the stock at market price or cost price, which is less. So sometimes you may incur losses, sometimes you may incur profits. So you try to disclose the profit, so don't concentrate on profits. Thank you.
Like, share, comment, and subscribe VNR Digital Learning Resource YouTube channel.